Good morning from our world headquarters in New York. I'm Magnus.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
It's all about bonds and jobs. We're counting down to the U.S. labor report that will help define the path ahead for the Fed. Mary Daly says the central bank may be able to avoid further hikes.
If we continue to see a cooling labor market and inflation heading back to our target, we can hold interest rates steady and let the effects of policy continue to work. Even if we hold rates steady exactly where they are today, policy is going to grow increasingly more restrictive as inflation and inflation expectations fall.
Bloomberg has learned that Exxon is in talks to acquire Shale-focused Pioneer Natural Resources. It's potentially one of the biggest deals this year. And it's been a tough 24 hours for Elon Musk. The SEC seeks to force the billionaire to testify on Twitter. And Tesla, it's cutting its prices again. Good morning. There's only one number that you've got to focus on. It is your jobs number, 170,000. Will it dip like ADP did? This is the state of the play in the bond market. We've got yields just rising ever so slightly. Mary Daly really being very clear. The market has done for us pretty much what we'd hoped for, that tightening from the yield market. Real yields are at a 20-year high. That will transmit at some description. Still, the houses out there, Bank of America say there's scope for 10-year yields to get to 5 1/8. What will Stephen Major, the Uber bond bull, make his call today? SocGen say the clearing rate for this bond market is 5, 5.25%, 5.5%. So let's see what the jobs number does to redefine risk. Do you want a real amount of risk going into this number? Probably not. Crude manages to go back in the green, down 9% on the week. Goldman says you don't want to pay too much attention to those gas numbers from yesterday. They say a soft landing remains on track. It is but a fleeting moment in the gasoline inventories. I thought we'd pop the dollar up there because ING, wrap it up beautifully for me, Danny. The dollar is expensive to sell here, and we have a feel that a wobbling bond market is the reason why you may just want to hold on to a few dollar longs. Danny, good morning.
Good morning, Magnus. Well, we're holding on to everything right now and waiting until we get that jobs number. Very calm morning, not surprising again for an NFP payrolls day. S&P and NASDAQ futures, little change. European stocks, they have been surprisingly resilient amid the pummeling of this global bond market. But SocGen does say that 5% 10-year yields, that's where the market is expecting it to go. And should that happen, S&P will go to 4,000. S&P futures right now at 4,292. They still say buy the dips over the next 6 months. Now, Bank of America points out, Magnus, that it is the bond market that has priced in a recession. So the good news from them, this is from Michael Hartnett over there writing in their weekly Flow Show report, that should we actually get a recession show up in the data, because the bond market has already priced it in, that sovereign bonds, that treasuries, will be the best performing asset class of first half 2024.
And yet still, the money flows in, Danny, to the very short end of the money market for funds. 64 billion went in last week. We have now got a record amount in these money market funds. And that caused us a lot of dislocation earlier in the year. 5.71 trillion has gone into money market funds, up from 5.64. So again, this is the kind of velocity that you've got in that race for cash. We've had various guests this week come on the show and say, I want to hide in cash. Danny.
And that thing is concerning, Magnus, because these money market funds, the frothiness of them and the stark pull out of it during COVID is what forced the Fed to step in. Look, there's been plenty to worry about this week. So here's a quick recap of what some of our guests had to say about the dramatic moves in yields.
Everyone's concerned about catching a falling knife.
Bond volatility has been the bogeyman recently.
Typically with markets, things do overshoot. The 5% level is quite a scary level. We also need to focus on real yields.
It's really hard to know where we go from here.
I have a feeling that people haven't actually woken up to the fact that for the first time in over 20 years, the yield on the bond market is actually higher than the yield on the equity market.
Something has to happen to make more people want to buy more bonds.
We're seeing a little bit of an oversold market here headed to 5%.
I think the fair value is somewhere closer to 5%. But don't assume that just because it's around 5%, we're there and so people should buy bonds. No.
A 5% 10-year treasury is decent value. It's not great value.
Let's add another expert voice to that. Stephen Major, HSBC's Global Head of Fixed Income Research, joins us now. Stephen, I want to pick up where Bill Gross left off. He says decent but not great value. Is 5% on the 10-year yield just decent value to you?
You're talking to someone who's been very wrong, because I would have thought there was good value at 4, so 5 should be even better value. I think we've been wrong for mainly the right reasons. So we need to see these conditions changing that have caused this. So many of those guests pointed out the valuation piece. So real yields are above trend GDP. Bonds versus equities, bonds look good. Bonds versus cash are looking good, looking better at least. So the valuation piece is there, but the conditions that got us here, it's the deficits, therefore increased supply, with good times maintaining in the economy, no recession, and an inverted curve. Now, it seems to me that you could be getting to the point where maybe 2 out of 3 could be shifting. So if the data starts to tip away from good times towards bad times, then there's no lack of demand for the increased supply. So where we've been wrong is the fact that normally I don't think deficits matter, but investors have been asked to take these bonds when there's a big inversion and there's loads of them. So if you can remove the inversion and change the data backdrop, then the valuation piece will come in as well. So I think slowly the conditions are getting better.
Well, it takes a pretty big person to come on the show and say, listen, I've been wrong all the way up here. But laying out your stall. Good morning, Stephen, by the way. It's good to speak to you from New York.
Morning, Magnus.
Term premium. I don't know the math. I'm not that intelligent, right? But you are. So term premium is turning higher, and this is part of the narrative for you. I know that. Is it rich enough for you to make a sort of a doubling down on your it is time to get long, or do you think you need to see more term premium before this market clears?
Yeah, so term premium is a symptom of something quite big happening. The last time we were writing about term premium was in 2014. That's after the taper tantrum, when it was really high. So that tells you something. So just to be clear, term premium's that additional bit of yield you get on top of what you would have had if you were just rolling bills. So it's the additional yield that you get from bonds as opposed to just holding bills through the life of that bond. Now, under most measures, it's risen by about 100 basis points, Magnus, and that puts it back to levels of 15 to 20 years ago. So it's definitely more interesting. You are now being compensated to go into bonds, and I don't think you were so much before. So yes, the term premium is probably the signal of the capitulation. And if I go through these last 3 years where the yields have been rising, initially it was because the Fed and others were behind the curve, behind the inflation. Secondly, they doubled up and they went for 75 basis point hikes. You got a huge bear flattening. Right. And now the third stage has been the back end flipping, which is the term premium piece. So it could be that we're there, but, you know, someone like me, I have to say these things very quietly now because you come on this show, you say something big and you get hit immediately.
Unfortunately, Stephen, whether you say it quietly or loud, we will take notice.
Thank you.
You know, look, I think this element of humbleness is interesting, that the surprise that the deficit has mattered so much to the long end. So to you, is that illogical? And if so, where is fair value right now?
I've made a thing, and most of the investors who follow our research will know that I say bonds are not potatoes. So you don't treat bonds like they're potatoes. They're sophisticated financial instruments. They can be repoed. They normally roll down the curve. The problem is right now they are like potatoes because they roll up the curve. So when you have an inverted curve, they're falling in price, and there's loads of them, and they're rotting. So they're just like potatoes. So you need to change the conditions that have pushed the bond market into the situation where it's being compared to vegetables. So that's slowly happening. I mean, I never really thought supply could ever matter. Saying that an increase in supply means a fall in price is kind of naive because it presupposes the demand backdrop and all the other complexities. So it looks to me that with a recession, and here we come back to the data, with a recession, you won't have any lack of buyers at the right price.
So here's the thing then, Stephen, and we've got a piece of that, an important piece of that data today on wages and on jobs. You used a very interesting word. You used the word capitulation in conjunction with term premium. So I stand here for 4 days in a row going, bond vigilantes, unanchored moves in the bond market. Now, it's not. This is not what I would call parabolic, unanchored moves in a bond market, because you've lived through them, as have I. How would you describe this move? And if you're using the word capitulation, that suggests to me we're at some kind of an exhaustion point in this bond move.
Well, it seems to me it is. It depends on what your reference point is, Magnus. This time last year, we had a UK fiscal event, and I think we had a 100 basis point shift in one day on the UK gilts. I can go back and I think 2014, we had a flash crash when yields went down. So they went in the other direction in a huge move. It looks to me that like this last 100 basis points or so is mainly explained by term premium, and it's come through the last 2 months. Maybe it's not of the same speed as the UK move from this time last year, but look, it's on top of a big move already.
Yeah.
So I use the word capitulation because I think there is evidence of throwing in the towel, and that's what I mean by capitulation.
Stephen, we have much more to cover with you. Stay right there. Stephen Major there of HSBC is going to stay with us. First, though, some top stories trending on the terminal this morning we want to make you aware of. Former U.S. President Donald Trump is endorsing Jim Jordan of Ohio to be the next U.S. House Speaker, saying the hardline Republican has his, quote, complete and total endorsement. Now, at the same time, the New York Times is reporting that Trump revealed nuclear submarine secrets to Australian billionaire Anthony Pratt at Mar-a-Lago soon after leaving office.
Well, the FTX co-founder Gary Wang has taken to the stand in the Sam Bankman-Fried trial, saying he and his former childhood friend and MIT roommate committed a multi-billion-dollar fraud. Wang is cooperating with the prosecutors after pleading guilty to fraud. Now, his testimony promises to be among probably the most powerful in the government case against Bankman-Fried, who's pleaded not guilty. Danny.
Now, Iranian human rights activist Narges Mohammadi was awarded the Nobel Peace Prize for 2023. Mohammadi was awarded the prize for her fight against the oppression of women in Iran and her fight to promote human rights for freedom and all.
Well, coming up later this hour, we'll have more on the big deal brewing at Exxon, the energy giant's biggest since 1999, as it seeks dominance in the U.S. shale production. But up next, more from Stephen Major at HSBC. We'll get his view on the Bank of Japan and the global perspective that's taken hold of the bond markets, right here on Bloomberg. This is your Friday edition of Bloomberg Brief with me, Magnus in New York, Danny Berger in London. We got there, Danny, but we didn't manage to break anything. The bond markets did that for us. Let's talk about JGBs and the Ueda shock and the Bernanke taper tantrum, which Mr. Stephen Major of HSBC, Global Head of Fixed Income Research, lived through and survived. Stephen, this is from Martin Malone over at Oral. He said, Magnus, take a look at this. The taper tantrum, 2013, as you remember well. But the YCC, the dislocation of YCC, to what extent did the ripping off the Band-Aid of YCC have a more global impact, perhaps, than we are assuming? Good morning, Mr. Major.
So it's a good idea to compare the two. So in March 2013, Bernanke was already talking about it. There was a paper that mentioned term premium 15, 16 times. So no one was listening. It took until May for people to start to realize that they were serious about going from QE infinity to QE end. And then it got really moving, it got motoring through the second half of the calendar year. With this one, the first move from the BOJ was just before last Christmas. And we've had other iterative shifts since then. And actually, in the current guise, the YCC includes the number 100. So that there is a tolerance for JGB 10 years to get to 100. The 40-year was through 2% this morning, which I think someone picked up on Bloomberg. So everything says that we're on the way towards what is some measure of fair value. So Bank of Japan modelling has put it between 80 and 100.
Mm-hmm. Right.
How much of a surprise would it be if they ended YCC right now?
I mean, maybe not a surprise because more folks see it coming. But if they do, what does that do to the picture that Magnus just showed us?
Yeah. So let's look at the counterfactuals. If they had done this 2 years ago, when the US 2-year was 15 basis points, it would have been pretty explosive. But if the 2-year is 5%, 500 basis points, then obviously there's more scope for global fixed income to soak this up. So I don't think it's a huge surprise. Put it this way, if you were a strategist working inside the Bank of Japan, when are you actually going to do this exactly? Do you think that you can wait another year? I mean, wouldn't it be a crying shame if you went through a whole interest rate cycle and they missed the chance to get rid of the YCC and the negative rates? So it seems to me that they must be ready to go soon. And I think that the issue for them is the noise and the volatility. So it's trying to do it smoothly without creating big eruptions. But the idea that higher JGB yields means higher Treasury yields, I think that's one for in the past. I don't think it's going to matter so much now.
OK, that's fine. But you do draw the comparison. You say the prevailing US exceptionalism, as if outside events just don't matter. So you've put down your stake that the recession could come, the data could roll over. But you talk about a new normal of the US economy was made 25 years ago under Greenspan, and that was questioned. You are worried about other events that could come to pass, aren't you? And what is the biggest event? So, contextualize it briefly.
Yeah. So thank you. You've seen it in our research. So it's easy to look at the cyclical and the local factors for the US. So that's the data and maybe regional banks. But globally, what's going on in China? What's going on in Europe? This divergence between the big blocks in the global economy, that does not go unnoticed. Now, is it through the FX or capital flows or through trade or some kind of contagion? I don't know, but it has to matter. And we look back through history and you see these great divergences, that they tend not to end well. So without knowing exactly how this plays out, it looks to me like it's another thing that we should consider. At the moment, the market's pricing US exceptionalism, but you know, how far away can US yields get from the big blocks in Asia and Europe?
But still, I look at Europe and I look at what yields have done over the past 2 weeks, and it's hard not to say this isn't fundamentals. This is the U.S. This is the U.S. bond market causing this sell-off. So what does that mean for Europe if the bond market is being bullied around?
So, and notice that European yields have followed the US, but Chinese yields haven't. So there's definitely an Asia-Europe-US disconnect here. So the last thing Europe needs is higher bond yields, because you would have thought that the data, if you just looked at the data, it was pointing more to recession risks in Europe than just about anywhere else. So look at the loan growth, for example, and some of the recent incoming. So this is the last thing that the ECB needs right now. And to me, it just kind of bakes in the cake the idea that we're at the peak in the cycle.
Okay.
And really, it now becomes a question of when the rates go down.
Let's get two last stakers in the ground from you. You know, you started the show by saying, "Look, I was wrong on the way up here," but you do like gilts and you do like UK long-dated paper. Where can that get to in the medium term? Put your stake down for Christmas.
Well, yes, we shouldn't be too encumbered by what's happened. So we take a clean sheet of paper, you look at the long-dated real yields, and it's the UK and US that stands out.
Yeah.
And I think that hopefully we've learned our lesson. We've been wrong. But it's the entry point. I mean, how wrong can you be when you've got real yields that are so far above the trend GDP and the valuations of bonds versus equities starting to be in your favour? So it's the long end of the UK and US that we like here.
All right, Stephen, looking forward to you joining us again shortly and being able to say you were right this time, Stephen. Stephen Major of HSBC, always a humble gentleman joining on the show. All right, as we had to break a quick check on these markets, much more calm, but it is jobs day, so that is not surprising. The long end, that's where the value is. UK 10-year yields, those just above 4.5%, 10 years 4.7%. This is Bloomberg. This is Bloomberg Brief. I'm Danny Berger in London, alongside Magnus in New York. The SEC is seeking to force Elon Musk to testify as it investigates the billionaire's purchases of Twitter shares ahead of his takeover of the social media platform. But, Magnus, that's not the only trouble Musk is facing. It's been a tough 24 hours for him.
Yeah, I mean, it's been a tough old 24 hours. We're also seeing more price cuts come through on Tesla, Danny. This is on the Model 3 and the Y. This is here in the US, and this was on the miss. If you remember last week, we did the miss on the quarterly sales, etc. And again, prices have been slashed. Model 3 comes down to 38,990, down from just over 40,240. So again, more price to come. And again, it's the battle for market share, isn't it?
It is. I mean, BYD, the cheaper Chinese-made electric vehicles, have really been nudging their way in. In other EV news, a really bad day for Rivian to a record drop, Magnus. They announced plans to issue $1.5 billion in convertible bonds. One analyst saying from Evercore ISI saying, look, the numbers were what we expected. It just came too soon, and the market, I guess, hated it.
Yeah, I mean, there's a small bounce back there. The stock sank by 23% yesterday, and that's below the IPO price. I mean, I think they were just surprised that they came for a call of cash so soon. One other piece of breaking news for you. We'll pick this up through the show. Unions plan to resume industrial action at the Chevron LNG site. So we'll keep an eye on that breaking news. Austrian Finance Minister joins the brief next, right here on Bloomberg. Welcome back to Bloomberg Brief. I'm Magnus in New York.
And I'm Danny Berger in London. Here's what you need to know. It's all about bonds and jobs. We're counting down to the U.S. labor report that will help define the path ahead for the Fed. Mary Daly says the central bank may be able to avoid further hikes. Bloomberg has learned that Exxon is in talks to acquire shale-focused Pioneer Natural Resources. It's potentially one of the biggest deals of this year. And it's been a tough 24 hours for Elon Musk. The SEC seeks to force the billionaire to testify on Twitter, and Tesla is cutting prices again. Calm in this equity market, but it is jobs day, so it's not unusual to see this morning. The handover from Asia was calm too, but of course China is offline. It will be interesting to see what happens Monday when those markets open back up from the Golden Week holiday. So we're higher across the board, be it S&P and NASDAQ futures. European stocks do even better, up 0.5%. But again, SocGen says that bond yields are going to 5%, and that when that happens, it's likely the S&P will go to 4,000. Magnus, we also just had some breaking news just moments ago. European natural gas prices have jumped. They're now higher by about 5%. That's off the back of the news that Australia's unions there around the Chevron LNG sites have decided to resume their strike. They are going to resume industrial action. And as we learned earlier in the morning, that workers had accused Chevron of reneging on some of the commitments that were made last month, and that was to end a dispute that roiled global markets. It had really impacted, again, European natural gas markets. This pop up right here is all we've seen. So not a huge move, at least for now, Magnus, but something we're going to keep an eye on.
Well, we'll certainly bring that question on gas prices as a result of strikes, but also the weaponization of energy when we talk to the Austrian finance minister in just a moment. How prepared is Europe for another weaponization of energy? Across the asset board, yields this morning, they're nervous ahead of the only one figure that matters, which is the jobs report. 170,000 is what we're looking at. Yields pop just up. The question is, the message from the Fed, Mary Daly saying, look, the market has already tightened the extra hike that we need to do. We just caught up with Stephen Major. He said he's surprised how much deficits have mattered to the narrative within the bond market. He says term premium, which is at a 20-year high, is now something that the market will pay attention to. And he talked about capitulation in terms of a sense of exhaustion in this market. Crude is down by 1/8 of 1%. We've dropped by 9% this week. Of course, we saw the drop in the gasoline consumption in the United States. Goldman Sachs say very clearly, stop looking at that. That's not really something. It's going to be fleeting, if anything. The soft landing for them still remains on track. Again, going back to what Stephen Major said, once this data turns, there's going to be buyers aplenty coming in to gorge on these bonds. Bloomberg Dollar Index, it's expensive to short. That's the message going into this jobs number. The dollar is expensive, according to ING, and we feel a wobbling bond support that view on the dollar. So that's the state of play on the markets. Danny.
Yeah, and again, I find this thing from Stephen Major really fascinating, Magnus. The humbleness to admit, look, I am surprised, is what he told us, that the bond market was so obsessed with the deficit and so obsessed from supply. But we got to be honest, it's not just the bond market, it's also Fed officials. They've pointed to supply being an issue for higher yields, too.
They have indeed. And the other dislocation, just as we go into this jobs day, is that money is gushing in to those money market funds. 5.71 trillion has gone in, 64 billion last week. So that flow of money has not ended, and there are repercussions. We have seen that before. How will that play out again? Danny?
It has repercussions in global markets. European yields are also moving higher. Now, all of this, the backdrop geopolitically for it, is EU leaders gathering for a second day in Spain. That's after Ukrainian President Vladimir Zelensky urged them to stay united in the face of Russian aggression. U.S. Ambassador to NATO Julianne Smith sought to reassure European allies, speaking to Bloomberg TV yesterday.
I think American leadership is here to stay. We've seen the United States take the important leadership role ever since Russia went into Ukraine. We obviously have a temporary situation right now with this continuing resolution that does not include increased support for Ukraine. But based on broad support across Congress for U.S. support for Ukraine, based on what President Biden said when he got on the phone with our allies and with President Zelensky in recent days, and based on what you see in terms of polling across the United States, we anticipate that American support for Ukraine will continue. Americans fundamentally understand what's at stake.
Let's now go to our European correspondent, Maria Tadeo, who's been on the ground in Granada. Maria, what's top of the agenda?
Well, Danny, there's a lot on the agenda today, but just to take a moment, of course, to reflect, as you say, on this diplomatic mission that President Zelensky was in yesterday. Really a hectic 24 hours for the Ukrainian president. He got here in the morning, and as far as I know, he should be back in Ukraine now. And again, his message was that of unity. He repeated this is a moment where the United States and Europe has to support Ukraine. Just to let you in on an anecdote, by the end of the session, a number of reporters, including myself, we were taken into a room. We spoke with President Zelensky, and we asked that question, however, do you fear the Biden doctoring money and weapons to Ukraine is coming to an end? This is a man who's obviously very aware that this is an election year in the United States. He says that is a dangerous prospect. He talked about some strange voices in U.S. politics, but he also said there's not been an easy day for Ukraine ever since the war started. That's on the diplomatic front. When it comes to the logistics of the war, the Ukrainian president has said that, of course, the counteroffensive continues before the weather changes. And when it comes to the winter, he also said the country will need more air defense, because what they fear now is that we're going to get a repeat situation of what happened last winter. Remember, Russia hit their strategic infrastructure. The power went down. The electricity went down. For some days, the country went into blackout. President Zelensky says he wants to avoid that this winter.
Maria, thank you very much for that. That's Bloomberg's Maria Tadeo reporting from Granada, Spain. Now let's dig more into the picture of not just the geopolitics, but how that interacts with the economic picture facing Europe. Joining us now is Austrian Finance Minister Magnus Brunner. Magnus, thank you so much for joining us, Minister. Look, the global landscape in front of you at this moment. You have yields marching higher across the world, but in Europe specifically. You have China delivering less velocity than many had hoped it would. So Austria skirted a recession so far this year. Are you confident that it can continue to avoid one and that you will have a strong bounce back in 2024?
Well, I'm always confident, but not naive. That's my attitude. No, we're in difficult times, very challenging times, I would say, economically. We did quite well last year, having a growth of GDP of more than 5%, which is above the European average, above Germany. We always compare ourselves to Germany, have to.
Everyone has to.
Everyone has to, but especially Austria, of course. We were doing quite well, but of course now the times are different. And especially because of Germany also, because we are very much dependent on Germany. And sort of we're going into a recession in the third and fourth quarter of this year, but the expectations for next year are not that bad. We're expecting growth of more than 1% for next year, so I'm still quite optimistic.
Good morning, Minister. Good to see you. That optimism obviously depends on a great deal on the global stage. France is flatlining. Germany is the sick man of Europe. China is not growing. So what is it that's going to help you be confident that you return to growth in 2024? What is it that's going to drive that growth for you?
Well, especially how we present our budget. That's probably the most important thing. And we've got some things to do in the budget, definitely. Challenging times also for budgets in all over Europe, especially because I talked about the dependency of Germany. And we are all in the same boat in a way, because there are all these export-orientated countries like Germany, like Austria, like Sweden, Netherlands and others are in difficult times. But what we have to do now in our budgets is to set the right scene for next year. We've got some priorities to do, like we're setting a lot of priorities on microelectronics, for instance, and to get the economy up again in the next year to come.
Well, you've long been a proponent of stricter fiscal rules for the entirety of the EU. We're in this situation now where you have both France and Italy looking like they're going to go above the 3% limit. What is at risk for Europe?
Yeah, we need new fiscal rules. We're just discussing these fiscal rules on a European level. Probably next week is sort of the next challenging time. But we have to, well, first of all, we have to get new rules. That's for sure by the end of the year. And I think we need some sustainable fiscal rules. I think that's a good attitude to have, in my opinion. Get more transparency also and more enforceable rules, because we had rules in the past which were not very enforceable.
So what happens if we don't get that? What's at stake?
Well, we stick back to the old rules then. That's for sure. We definitely need rules, and if we don't get any new rules, we stick back to the old ones.
Well, the old rules, many people sort of fudged them in the first instance, Minister, time immemorial in Europe. I want to deal with a story at hand at the moment. We're tracking gas prices this morning. There's a strike in Australia. That's a constriction on supply. I want to get a broader perspective from you on Europe. Gas prices have plummeted since the Russian invasion of Ukraine. How prepared is Europe for a new weaponization of energy in this winter? Are you prepared? What are you doing? Are you on the front foot?
You're perfectly right. I think Russia and Putin uses gas and the energy altogether as a weapon against Europe, against the world, against Ukraine. And we have to prepare ourselves in the EU member states. And I think Austria is well prepared. Our gas storage capacities are very high compared to other European countries, and the gas storage capacities are full by more than 93%. So we are very well prepared for the winter which comes up. That's the good thing. And we have to work on more diversification of our gas system, because we were very much dependent on Russian gas, not only Russian gas, but rather the pipeline gas. And it was very good for our economy in the last years, of course, because it was cheaper gas than the LNG. Yep. And as Austria hasn't got an LNG, hasn't got a sea access, as you know, we are very much dependent on the pipeline gas. But we managed to diversify in the last months, more to Norwegian gas, more to other gas systems, and that's a good perspective.
Now, one of the other issues facing Austria, and let's be honest, the world is facing this right now, is labor unrest. You have metal workers in Austria asking for a nearly 12% raise. Social workers, it's 15%. Can you realistically afford that? Can the country afford that?
Well, it's not in the politicians' hand to do these wages and the rises of wages. That's in Austria. It's the social partners who discuss that. But you're right. I mean, that of course fuels the inflation again, and the Austrian inflation is too high. We are now above the European average. We used to be below the European average last year. We're at 6.1% now. On the EU statistic level, we're at 5.8%, which is far too high, but there are different reasons for that. And one reason is of course, the very high wages, the rise of the wages. We are the highest in Europe, together with Belgium, and that fuels the inflation again.
Minister,
That's a big problem, yeah.
Very briefly, a response to, we've just caught up with Maria Zelensky, is speaking there about the concerns around the lack of funds or the break in the momentum of funds from the United States of America to Ukraine. How concerned is Austria? How concerned are European peers? Briefly, a response to the break in funding from the US.
Well, we are, of course, supporting Ukraine with all we can do. I just had a meeting with the EBRD this morning. We are supporting the EBRD. We're supporting the EIB as well. We're doing a lot as a small country, a small European country, to support the Ukraine. We have to stick to that as a European Union, but as a world altogether.
All right, Minister, thank you so much for your time. That is, of course, Magnus Brunner, the Austria finance minister. Now, coming up on the program, a big deal is brewing at Exxon. The acquisition that could be the energy giant's biggest since 1999 as it seeks dominance in U.S. shale producing. This is Bloomberg.
This is Bloomberg Brief. I'm Magnus in New York, Danny Berger in London. So Bloomberg has learned that Exxon, Danny, are in talks to acquire the shale-focused Pioneer Natural Resources. It's a deal that could be worth as much as $60 billion, potentially the largest acquisition this year. Joining us now is Will Kennedy, hot back from the Middle East, where he's been talking oil all week. So I want you to shift from pure commodity to pure deals. This is a beast of a deal. Does it make sense?
It's a very important deal, and I think if it goes through, could end up being seen as a landmark deal in the oil industry for several reasons. It will be Exxon's biggest deal in almost a quarter of a century since 1999, and of course be the defining move of Darren Wood's time as CEO. But what it would really do is change the landscape of the shale industry. Shale has been a boom that's been driven by the independent sector, companies like Pioneer, rather than the oil majors. They've got into it more latterly, but this would make Exxon by far the biggest beast in the Permian. They would have more than 1 million barrels a day of production from the Permian Basin alone, and they would be the dominant player in the US shale industry. So it really would change the landscape of the oil industry in the United States.
The backdrop for this is the conversation around $100 oil, and we were getting close there. We're above 90. Now we've slid back below $80. There's all this concern about demand, but Will, how warranted is it?
It's really interesting, and I was having a couple of conversations in the Middle East this week with people who sell oil, essentially, and they were saying that, you know, they don't see the demand weakness. If you look at Saudi Arabia released its official selling prices. Those are the premiums they sell oil at over and above the market price, and they put them up. And that's a sign that they're confident that the oil market remains quite tight and they can place all the oil that they want. I think there's a feeling that the price action has been driven by the wider gyrations in macro markets, perhaps some profit taking, perhaps some very elevated prices last week on the front month. Well, the broader theme people seem fairly confident still.
Yeah, they do. I mean, those cuts are still there from the Saudis and the Russians. The Russians have just taken off their embargo. Will, we didn't actually get through any more. You've had a great week in Abu Dhabi, great interviews with the Indian oil minister and beyond. I look forward to an upsum. Make sure you file that before you take the afternoon off. Will Kennedy there, tracking the oil movements. And we're going to stick with a quick check on the markets. It is jobs day. 170,000 is the number that is penciled, etched in your brain. S&P are slightly in the green. You got the dollar holding on to some gains. ING said it's expensive to short that Yankee. Good morning from New York. This is Bloomberg Brief. I'm Magnus in New York, Danny Berger at London HQ. We're counting down to the main event of the day, the jobs report for September. It's due at 8:30 a.m. Eastern Time. Michael McKee got up early for us. He braved the early morning call ahead of surveillance. He is, of course, our international economics and policy correspondent. Good morning. Mike, good to see you. 170,000, it's the number that's in my brain. But take me beyond that number. Or is that the critical number versus wages? How do you break it down?
This time I think it is the critical number, and the reason is the bond market and what's been happening in the bond market. It's almost less important what the numbers are today than how the bond market reacts to that, because as you heard Mary Daly on Bloomberg yesterday talking about how the bond market is functionally given us another quarter point of tightening. And so if we get a strong number today, you may see the market do the same thing and may start to get ahead of the Fed. Right now, we're expecting 170,000, as you said, and we're expecting the unemployment rate to fall. Last month, it went up 0.3, a big bump because so many people came into the labor force. That's not expected to repeat. And the wages number could be a surprise, but at this point, looks like it just sort of stays on the status quo.
Mike, I might be getting ahead of myself because I really don't care about September. I care about October. And I mean, that's because it is backwards looking by its very nature. That's what I'll stick with. But as we're entering a world of tighter financial conditions, will we look back on the report today and say, hey, perhaps that was peak, that was as good as it gets for this American job market?
Well, there's some people who think so. Bloomberg Economics is suggesting this is going to be the peak, but there are other analysts I've read who are saying we shouldn't see a whole lot of fall off at this point. We're getting into that time of year when companies are hiring extra for the holidays, and the question is, do they hire as many people as they normally do? If so, then maybe things don't drop off. If they think we're going to go into recession, they might drop off. The interesting thing today is that the market is leaning towards the idea of a stronger jobs report. The whisper number out there is 190,000, while the forecast is 170. So the market thinks maybe we're not quite there yet. We're still going to see some strength going forward. But you're right about September in the sense that September is not going to show any of the strike activity. The UAW and certainly the healthcare workers who went on strike won't show up until the October payrolls report in November, which comes after the next Fed meeting.
How tight is the wages market here? I mean, it's been something that has been constant in the reports in terms of the wages, the tightness, and organizations holding on to people and paying up. We've gone through a few strikes, as you say. Some of them have been resolved, some are still ongoing. That tightness in the wages market is what Larry Fink referred to with Danny. He talked about embedded structural inflation. So how important is the wages numbers today?
The wages number is important, but it has been coming down. So the Fed sees progress there. I mean, we were seeing people get 6, 7, 8, 9% increases to come back to work. Now that many of those positions have been filled, we're running at a 4.3% annual rate, and the Fed thinks that's just a little bit above the 3 to 3.5 that they consider sustainable. So at this point, it's beginning to look like progress is being made, and if that continues, then the Fed's going to be seeing, they hope, some progress on inflation. All we have is anecdotal data, but a lot of CEOs are telling Fed officials, who are telling me, that they don't have to pay as much to get people to come to work these days.
Do we just need Beyonce and Taylor Swift to go on another round of tours, Michael? Is that what's going to save us?
Well, yes, because then Danny can get tickets. You know, she's coming to London, and I'm sure you're standing in line for that. There is
for research purposes.
There's an argument about the big tours this past summer having added a lot to GDP. The numbers are kind of all over the place, and it depends on what you use as a multiplier, how many extra jobs are created by the jobs that are created. But there are rock tours and music tours every summer, so I'm not sure how many additional people got hired. Taylor Swift had 2 crews alternating, so maybe they added a couple hundred people to the payroll, but that's not going to make a big difference in the overall number of jobs. And besides, all those people would have started back in March when she started her tour.
Yeah, well, Taylor Swift's too busy with football and going to football at the moment, so maybe
don't go there. Don't go there, Magnus.
Don't go there. Maybe that's a broader conversation. Mike, good to see you, and we look forward to you breaking those numbers on surveillance in just a moment from Danny and I. Look, you know, we didn't break anything, did we, Danny? But the bond market felt as if at one stage this week it asphyxiated at just over that 480 level on the 10s.
Yeah, I feel like Mary Daly in saying we didn't do the thing, the bond market did the thing for us. So an eventful week. That's it for Bloomberg Brief. Surveillance is ahead. Good morning from London.